Don Luskin, I was terribly interested to read in the notes that you see a serious recession risk ahead. Tell me about that, and what's that mean for stocks?
Well, this isn't new, Larry. I've been saying this for quite some time. The macro data that we see doesn't show any signs of recession, but over 30 years of being in this business, I've found one indicator that is flawless in forecasting business cycles, and that is S&P 500 forward earnings. When year-ahead earnings start moving down, in other words, when they're being downgraded on average, not upgraded on average, that means that a recession is anywhere from 3 to 9 months in the future. And the peak in forward earnings in this cycle was last August. So we are getting there.
Let me just cross-examine quickly. How big is the downgrade, Don?
The downgrade is only about 2% so far in the U.S. In other countries, it's massive. We're looking at 17, 18% downgrade in Italy, 10% in Germany. Obviously Europe is already in recession, so in the U.S. it's small, but in certain key sectors it's gigantic. So forward earnings in the financial sector are already down 10%. That doesn't mean you're going to get a big recession. It doesn't mean you're going to notice that you're in a recession. I'm not saying that.
Bearish for stocks. It's got to be really bearish for stocks.
No, Larry, it doesn't, because whether there's a bear market or a bad one associated with a recession is a question of valuation, not a question of business cycles. There was no bear market associated with the 1990-91 recession. Stocks were up during the whole thing, whereas in the 2001 recession, which was a very mild recession, there was a 50% bear market because stocks came in so overvalued. Stocks are so cheap right now, don't worry about the business cycle.
All right, I'm paid to worry, but I want to go to Lee Munson. In your notes, you say you don't see a recession threat. In fact, you see 4.5% growth.
I do, and you have to remember 4.5 is just trendline growth. We're still not going to get, maybe 5.5 or 6 that we would need to really jumpstart, the growth that I know, Larry, you like to see. But I don't see a recession. Now, I will agree with Don on some side that I don't expect any more than, say, 0 to 5% increase in earnings on the S&P 500, and I do think it's a matter of multiple expansion. But we also saw last quarter we did take in, a 1% haircut because of, government spending getting taken out of nominal GDP. But we also saw residential construction up 10%. So we are seeing signs of life in housing, and we've had 4 quarters where that residential side has really made a positive impact on GDP. So I don't think we're quite in recession territory. I think that we're going to grow just fine. I think we're going to be okay this year.
All right, let me go to
there's one thing in this morning's numbers, Lee, though, that you really have to acknowledge, and that is so much of the real growth report today, 2/3 of it was in change in inventories. And when that happens, that means you're just going to have to give it back in the next quarter, because inventory changes over time always have to sum to 0. So you have a big one in one quarter, you get a negative one in the next quarter. That's just history. This coming quarter isn't going to be great.
I agree that we could have some spillover from last quarter, and I did think that it was pretty shocking that right year-end inventories and the numbers that you're talking about, but I still think in the second half of this year, we're going to go back to trend nominal GDP approximately 3 months, and we might slide by without it, especially if the government starts buying up more debt, buying up some more of these MBSs.
Lee, the trend since 1973 is actually 2.9%, which is what we've got right now. So if we get the kind of numbers you're talking about, hallelujah, I only pray that happens.
Well,